Hey, I'm Jason, and this is Supply and Demand Daily, where I tell you what we learned about the economy today. Today is going to be more of an update on inflation, and I also have an update on data that I am releasing in a separate video, but I wanted to make this one separate just in case you don't have time to catch all of the videos, and I just think that it's important to talk about this because the Consumer Price Index for May, that is the way that economists and policymakers, some policymakers, and most of the various industries that track inflation, that's the way that they do it using the Consumer Price Index. So that is a basket of goods, and there is an institution called the Bureau of Labor Statistics as part of the Labor Department in the United States government that tracks the prices of all those goods and records the inflation rate every month. It's not perfect, but it's what we have. No measure of inflation is exactly perfect. But anyway, what I wanted to share is some charts and an update on the inflation situation, as well as what factors are going to play in to what the numbers will look like tomorrow. My personal prediction based on the evidence is that the level of inflation is going to be higher. So we're going to see, I believe that we're going to see a higher monthly rate as well as possibly a higher annual rate, but I'm looking for the monthly inflation rate to be higher. They're recorded on it's recorded on a monthly basis, but the most commonly released number in the data is that annual inflation rate, which is where you take the consumer price index right now and you subtract the consumer price index from exactly 12 months ago and you find the percentage change. So that would be an annual inflation rate. It's not my favorite, and we'll talk about why here in a minute, but in order to do all that, I'm going to go ahead and get out of the way. And the other thing that I'll be doing is sharing an article at the end of my slides here that add into the reason that I think we're going to see a larger increase tomorrow. Could be totally wrong, but we'll see. All right, so what I have here is the green line that is definitely kind of being overshadowed by the purple line. The green line is that headline annualized inflation figure going all the way back to 1985. And the purple line, what that is the 3-month annualized monthly inflation rate. Now that's a lot of words, so basically what that is again, this consumer price index is recorded monthly, so you can track the monthly percentage change as well as the percentage change from 12 months ago. The advantage to tracking the monthly percentage change is that it eliminates the infamous, what's been talked about very recently in the last year, base effect. So the idea of a base effect is that if I take $20 and I add it to the price of oil, so let's say that the starting price of oil at the beginning of this whole thing is $50. If I take $20 and I add it to that, then oil has gone, over the course of a year, then oil has gone up 40% on an annual basis. Okay, on a 12-month annual, just do the basic percentages, 40%. That's a pretty substantial jump, right? Okay, but now the price of oil is going to go up by the same amount. We're going to add $20 again, but now we're sitting at a base price of $70. And so even though the oil is still increasing by the same dollar amount, it's only going to be a 28% increase if it's already gone up by 20 the year before. And so base effects are vulnerable both to making inflation look larger when it's coming from lower price years like 2020, for example, April, May, June of 2020, when prices actually went down for a lot of stuff. So it can make inflation look higher in that sense, but then it can make it look lower after prices have already gone up a lot. And so for that reason, a lot of people will look at this 3-month annualized, or they'll just look at the monthly rate of change. What I like about the 3-month annualized is you can compare it directly to the annual, this 12-month on this year-over-year inflation rate. And so the way to 3-month annualize, it's not actually the most complicated thing in the world. You just sum up the last 3 months of percentage increases and you multiply it by 4. So it's like saying that the inflation rate that has been happening, the inflation that has happened over the last 3 months, you're going to take the number that would reflect if that same thing were to happen for the rest of the year. That's the idea of 3-month annualized and why I like to use it. Now, what you find when you look at this is that often, not always, but often, the 3-month annualized will lead the 12-month, the year-over-year figures. Okay, so the 3-month will often lead the year-over-year figures either in the positive or the negative direction. When we look at this, we see that the 3-month annualized definitely led the recent inflation episode upward, and it is continuing to do so. So it's hanging out above the annual inflation rate. The annual inflation rate is something like 8.5%, and the 3-month annualized is 9.5. Now, this is just the 3-month annualized going from the beginning of 2017 all the way to now. And you can see it's kind of tempting to draw a nice trend line because you can kind of see a trend building there and extrapolate from that it's going to keep going like that. But the thing about inflation is it's kind of a complicated process. You have supply constraints, but the most important consideration is the growth of credit in the economy. Because credit, and by that I really just mean purchasing power, that grows through the lending of money, the lending of new money into existence by both private institutions and government institutions, such as the Federal Reserve, mostly the Federal Reserve on the government side. But so you have all of these complex interactions, and so you can't really even determine if there's going to be a uniform lag between credit expansion and rising prices. You don't know what that interval is going to be, and you can't really go drawing trend lines and assuming that it's going to continue that way because experience shows that they just don't. Now, one thing that I can say is that the growth of credit, and this is where I'm kind of getting into, why I think we're going to see an increase tomorrow, another one that would mark over 12 months that we've been seeing these higher than normal inflation levels. Just to remind you, but one thing that I want to point out is that credit is definitely getting tighter. What I mean by that is it's harder for companies and individuals and households to take out loans, and what that's doing is slowing down the amount of demand, the amount of this additional demand driven by new credit entering the economy, new purchasing power. And what that means is that there's going to be less demand pressure on all of these goods and services, and that means lower prices, because when demand goes down, prices also tend to go down. Now, that is definitely happening. So what I'm showing here is the risk premium on AAA corporate bonds. So that's the debt issued by very high credit corporations with very high credit score, like you can think of maybe an Apple. And then the orange line is the credit spread on high yield, which is another way of saying junk corporate bonds. So lower credit, lower grade corporate bonds. Believe it or not, a lot of non-financial corporations issue debt via this high yield vehicle, and were able to issue a lot of debt over the course of the COVID-19 pandemic, and a lot of that had to do with the fact that the Federal Reserve Bank made a market for these exact types of bonds, and so made sure that they would not completely collapse in the demand for them. And so what this means is that, again, it's getting harder for businesses and households to take out loans, which slows down the flow of credit into the economy, and that's been happening about ever since the very beginning of this year, 2022. And just to point out and clarify, the left-hand axis is designating the rate on the spread on the high-yield debt, and then the junk bond debt, and then the right-hand side is the AAA debt, so the high credit score debt. And what this is telling you is basically the government's cost of borrowing, or the cost of borrowing for these corporations versus the U.S. government, which is the U.S. government approximates whatever interest rate the U.S. government is paying on its bonds. That would be USTs. Then that tells you approximately what the risk-free rate is, because government bonds are considered risk-free in finance, or at least United States government bonds are. Now, so credit is slowing down, but why do I think that inflation is still going to be elevated when we see the report next month, and maybe even higher on a percentage change on a month-over-month basis? Well, because most of the base commodities that are common to all of the goods and needed in the provision of services that we have in the economy, they're still going up. Either that or they're still extremely elevated. So things like iron ore, steel, corn, wheat, soybeans, all these different things. Across the world, we have palm oil is still rising in price, so much so that countries are banning the export of palm oil. So we have all of these base commodities that need to go in. They make up input ingredients in all of these different products that you and I consume every day. And they're still going up. There's still a lot of pressure on it, and they're not going up just because of scarcity. They're going up because the demand for them is still high, and we'll see an indication of that with Adobe's online price inflation report that they released today, June 9th, 2022. And then the other thing is that if, as I've been reporting the purchasing managers indices, they give you an idea of what the manufacturing sector is like and what the services sector is like. I've reported, many of those over the last couple of months. What those are saying is that a significant portion of purchasing managers are still reporting that the costs of their inputs are going up. So you have and when I say large proportions, I mean 75 to 80% still. And so it's very difficult to imagine that that we're near a peak if all of those prices are still elevated. Because what does that indicate? It indicates that the demand for those products, the demand for those inputs has not fallen substantially. And what does that mean? Well, it means that the demand for the retail end of those products has not fallen substantially. So it's certainly, we're starting to see pressures on credit, pressures on the issuance of new purchasing power into the economy, which will definitely slow inflation, but this definitely operates on a lag. Over a long time span, you can make out a lag of probably 9 months to a year, maybe 15 to 18 months, something like that, but it's not always the same. And I'll give an example about that here in a minute. And then this is showing the increase in prices of natural gas and crude oil. So the blue line would be crude oil and the orange line is Henry Hub natural gas. These are both based on the futures market for these commodities. And so they've gone up 134 and 232% respectively ever since January of 2021. So we're still in a rising energy cost environment. It's still taking a lot of money just to produce the same amount of stuff that we demanded a year ago and 3 years ago and 5 years ago. So that's what's going on. And so again, we're probably going to continue to see some inflation, I would say at least for the next 6 months. And then some highlights from the Adobe inflation report, which I didn't actually know existed until today. I saw it on Twitter. So thank you, Twitter. Shout out to, nobody. It's just, Twitter sucks in a lot of ways, but anyway, I don't want to get into all that. We have the Adobe inflation report that I thought was very interesting, and they track online prices, right? So they track online prices, and what their most recent survey showed, or what their most recent data showed, is that the sort of discretionary items, the kind of thing that people spend money on because they want to, not because they have to, but because they want to, well, there's starting to be some negative price pressures on those things, not necessarily on an annual basis, because if you can see this, I'm sorry, I know it's really small, but I'll just point out to you that we have a lot of very high year-over-year price increases, 2.54% for home and garden supplies, 6.6% for non-prescription drugs, 9.7% for tools and home improvement. But if we pan over the month-over-month, it's kind of the opposite. So a slim majority of product categories actually went down in May, and there's been some pretty large decreases, especially in the areas of sporting goods, apparel, toys, and electronics. So again, we're talking about things that people don't necessarily need to spend money on, but they do so because they want to and because they feel like they have enough income to both spend on those things and save, right? Or maybe just spend on those things. A lot of people don't save. That's their financial decision. The biggest rises, though, are in the essentials. So we see large month-over-month increases still in groceries and pet products. People are not going to let themselves and their kids go hungry, and they're not going to let their pets go hungry either. So that's what's going on with these different types of prices. It shows that there's a lot of pressure on household budgets, but the spending is a stop to the spending is really nowhere near in sight. So now I want to go to an article that I saw on Yahoo News on Monday, or Yahoo Finance specifically, and this is an interview or some excerpts of an interview with the labor secretary under President Biden. And the reason that I sort of keep tabs on what this guy is saying is because he heads the department that releases the Consumer Price Index. That would be the Bureau of Labor Statistics, and the department would be the Department of Labor. And so I'm going to read the title and pretty much all of the article. So it's titled, "Consumers Have to Face That Nasty Inflation is Here to Stay for a While." Let's see. This is by Brian Sozzi at Yahoo Finance. It's a quote, "It's a very challenging time right now with inflation," U.S. Labor Secretary Marty Walsh told Yahoo Finance Live on Friday. "Indeed, and the reality is nasty inflation is here to stay, at least into 2023. Sure, we could get the mild recession that some policymakers seem to want, and inflation may cool down as a result, but don't expect prices to pull back to levels you once deemed reasonable. If you want a new pair of jeans, as Levi's CFO Harmit Singh told me recently, buy them now." All right, so keep going here. Why are these brutal inflationary forces continuing? It's simple. There are structural issues amid the post-pandemic world that are feeding the inflation beast. Now, just a disclaimer, I don't really agree with this person's analysis of why they are saying inflation is going to continue. I believe that the fact that they're doing this interview and saying these things in general indicates that there is some advanced knowledge of what the report is going to look like on Friday, and so that's why I'm sharing this information with you. Why are these brutal inflationary pressures continuing? Blah, blah, blah. Skilled workers are too few in number to meet the needs of post-pandemic businesses, leading wages to climb. So, talking about the wage price spiral there, the wage price spiral in economics, which I don't think is a real thing. But again, this is somebody else's analysis. Even in a recession, skilled workers will be required to meet the demand is being seen. Supply chains are still stuck overseas, where the cost of labor and transportation remains on the climb. Those issues will hamper semiconductor production until 2024, Intel's CEO Pat Gelsinger told me. Oil doesn't grow on trees, and it has become a renewed political chess piece. That suggests prices above $100 a barrel or higher as the new normal, sitting at about $120 today. The tightness in the labor market this is another quote from Walsh. The tightness in the labor market is allowing labor to extract concessions on wages, bonuses, benefits, causing labor costs to, quote, chase prices higher. This will make it difficult for inflation to decelerate significantly from here, as businesses now have to pass higher costs back to consumers in order to preserve margins. Meanwhile, ample cash and borrowing capacity is allowing consumers to absorb high prices despite negative real wages, which sustains the positive feedback loop. Again, wage price spiral. Also known as cost push inflation, where the costs of production, including labor, including basic components, push inflation, push the increases in the consumer prices continuously. So what do you do about this attack on your finances? This is my favorite part. Stop complaining about inflation on social media, adapt and overcome. For example, consumers can make lifestyle changes by trading down to cheaper alternatives. Do you really need Crest whitening toothpaste, or will a private label brand just work just as well? Conagra Brands and others have reinvented frozen food. It tastes great and could be useful in one's cost-cutting efforts. Can you do all your food shopping in one trip to Walmart or Target to save on gas? This one-trip trend is already being called out by most major retailers as the driver of increased basket size. Instead of visiting Kohl's for a full-price bathing suit, head to TJ Maxx-owned Marshalls. Retail is awash in inventory after a bad first quarter, and I bet you could get a very nice bathing suit for under $20 at Marshalls instead of plucking down $40 at Kohl's. Not sure that price differential really exists. Kohl's is pretty cheap, but anyway. And before you tweet me a dose of outrage, I don't live in an ivory tower, and I've made a lot of lifestyle changes in recent months due to inflation. No shame in my game with eating frozen food or ordering things online to pick up in store. Reduces the impulse to wander a store and buy more, or even waiting for car parts to break before replacing them. Not the smartest decision, but whatever. As for how to adapt and overcome inflation's long-run reach on your portfolio, that's trickier because you can't control the stock market. All you can do is stay laser focused on long-term wealth-building goals, even if it's painful to stare at a trading account down 30% in Tesla, 20% in Amazon, and 15% in Apple. Realize none of these three companies are going to go out of business, and that chances are 5 years from now, all three will probably have higher stock prices than today. If you are a more active trader, I like liked this dose of wisdom recently provided by Charles Schwab investment strategist Liz Ann Saunders on Yahoo Finance Live. Quote, so you want to have a high quality wrapper around the types of stocks you're looking at. I think the factors that have been doing well and I think will continue to do well, which have this sort of quality wrapper around them, would be areas like strong free cash flow yield given what we are seeing in inflation rates, cash-rich balance sheets, and profitability. This is not the time to go into very long duration companies that have no earnings and prospects for earnings. Happy trading. So I mostly called that article out in order to share that the head of the Department of Labor seems to be preparing the media for a higher inflation print. I'm not exactly sure. Maybe I'm reading too much into it. We're going to find out tomorrow, and I will be, of course, up to date and ready to share that news with you as soon as it is available. So with that, I'm going to move on to my next bit on the economic data that was released today and an update on the increase in household net worth throughout the COVID-19 pandemic years. I hope you'll join me for that and join me tomorrow to figure out what happened with inflation in May, at least related to the consumer price index. I'd like to thank you for joining me for Supply and Demand Daily, and I'll talk to you later. Goodbye.